The Get Rich Slow Club podcast is a collaboration between Tash from Tash Invest and Ana from Perla. The Get Rich Slow Club acknowledges the traditional custodians of the land we record on. From coast to coast, across land, waters, and communities, we pay our respects to elders past, present, and emerging. Any advice is general and does not consider your financial situation, needs, or objectives, so consider whether it's appropriate for you.
Welcome to the Get Rich Slow Club podcast, where we take you from beginner to confident investor,
where we can teach you everything you need to know about investing.
So come get rich slow with us.
Welcome back. I have Brandon here with me again from New Money. For anyone who doesn't know you, do you have a quick 30-second pitch of who you are, what you do, why people should listen to you?
My name's Brandon. I make videos on the internet.
About money and
investing.
And value investing.
Value investing, which is what we're going to talk about. Again,
yes.
Thanks for having me on again.
So the last episode we did was like an introduction to value investing.
Yes.
So if you don't know what it is, go have a listen to that. But today we're going to talk about value versus passive investing and which one is the best.
Ding, ding.
But first, money win, money loss. Do you have one?
My money win was a week or two ago. I got free tickets to the footy. So
how did you get free tickets?
My dad organised it. I don't even know how he got the free tickets.
Amazing.
I think
free
he
tickets
told
are
me,
good.
But, I got to go up to Sydney and watch my team lose.
So was it a win or was that a loss?
It was a money win. It was an overall loss.
Yeah, not ideal. I'm in Melbourne recording this again, and Melbourne has my favourite smoothie bowls ever. So my money win is I bought a smoothie bowl and it was great. It was good money well spent.
Nice.
But they're getting a little bit expensive. So a bit of a money loss there. What is value investing? Quick 30-second
Recap.
For people who haven't. Yeah.
Do a recap. Value investing, Warren Buffett's strategy. It involves 4 key pillars. Number 1, understanding the business. Number 2, finding a moat. Number 3, understanding the management. Make sure they're operating with skill and integrity. And number 4, buying a good company at a fair price.
So my understanding, correct me if I'm wrong, is value investing is you are stock picking and trying to pick a company that's going to perform better than the market.
Correct.
True?
Yep.
Passive investing is usually buying ETFs and trying to get the average return of the market.
Mm-hmm.
Why doesn't everyone value invest? It sounds like a great idea.
It's because it's really hard.
Yeah.
No, the statistics aren't great for value investing. There's a lot of very experienced value investors that do very, very well. Like what we're saying, like Warren Buffett's the best investor that's ever lived and he follows this approach. But on balance, most people don't come out ahead. Most people lose money value investing as opposed to trying to versus passive investing where you're just getting the average.
Yeah, I don't stock pick at all because I don't want to do the research. I'm not an expert in it. I don't want to spend the time doing it. And I remember reading a stat from ages ago where it was like 90% of fund managers, so people who do this as a full-time job with a degree, they know all the stuff, they fail to beat the market longer term compared to just buying index funds.
Yep.
So my opinion is like if they can't do it, why can I? And I just don't even want to bother. So why do people think that they can?
Well, when you are an active investor, when you're a value investor, you get free reign over your own portfolio. So whereas if you're buying the S&P 500, too bad, you get every single company in the S&P 500. And for a lot of people, it doesn't sit so well with them because there are some great companies in the S&P 500, but everybody's, moral values and ethics are different.
Yeah, it's good. It's interesting from like an ethics perspective. If you want to make sure you're investing really ethically and it aligns with your values, the value investing approach definitely seems to win out because you really get to know a company.
Yeah, if you truly want total control and you want to invest, your number one priority is only investing in companies that align perfectly with your values, then you've only got one option really, and that is to hold individual companies that you've vetted and you've done the research on and that do align, which is, it's active investing, but for the purpose of this conversation, it's value investing. Yeah.
So do value investors really beat the market if they aren't Warren Buffett? Have you beat the market? Do people that you know have beaten the market too?
Yeah, so we should talk about why people don't beat the market. So yes, a lot of value investors do very well, like the Warren Buffetts of the world. It's silly to think that we're going to get the same return as Warren Buffett, the best that's ever done it.
Especially as people who don't work in the industry. Like if you're going to your day job and you're not looking at companies all day, every day as your job, it's going to be hard to match these people who do it all day.
Yep. Most people lose out because they're not rational enough. They can't get their mindset right. It's, as we know, investing is very much a mindset game. But when it comes to value investing, you really have to be rational.
What do you mean by rational?
So rational as in you're not swayed by what you see on TV. You can handle yourself when the market's going up. You can handle yourself when the market's going down. You don't make any rash decisions because the market is doing whatever it's doing at the time. And you are able to, every investor feels the emotions of investing. When the market goes up, you're like, oh, great. When the market goes down, you're like, oh, no. But value investing, the most important part to actually getting success with the strategy is being able to detach yourself somewhat from your emotions and make very rational decisions.
So does anyone beat the market? Any normal, regular people who aren't Warren Buffett?
Yeah, a lot of people, but it is very important that you do follow that rigid 4-step approach. So active investing or value investing can be really, people can define it however they like. It's just stock picking. It's trying to find companies that beat the market. And people can do that in all sorts of different ways. But the people that do it really successfully. So the first part of my investing career, I was just reading a lot of investing books from all the people that have done it very, very well for a long period of time.
Do you have good recommendations for us?
Yeah, One Up on Wall Street is great. The Intelligent Investor is a hard one to get through, but it is a good book.
It looks pretty ugly. I didn't realize it was written so long ago. Like I have it on my shelf. I've never read it properly, but it's from ages ago, isn't it?
Yeah, it's from, I want to say the 30s or 40s.
Yeah, well.
But it's written by Benjamin Graham, who started the cigar butt, the value investing approach originally. The best one I've ever read, the one that I like the most, is called Rule 1 by Phil Town, which goes through the 4 key pillars of the value investing approach. He calls it the 4M analysis. The reason that most people don't beat the market
I was saying, why do regular people do?
Why they do is because they follow the 4-step strategy.
And they're rational.
They're very
They're not making
rational
emotional decisions.
Yeah.
They're not on Reddit being like, oh, what's the next stock?
Yeah, they're not saying, oh, look, Jimmy over there said that stock was undervalued. All right, buy. They're taking the time. They're going step by step. They're making sure that they're looking at companies in their wheelhouse. They're analyzing the company for a competitive advantage. They're checking the management team. They're doing the valuation.
Like we were saying in the other episode that usually you make most of your money from value investing from a few wins.
Yep.
Do you need, like from my looking from the outside, it seems like you need quite a bit of money to invest to then make this worth it. Like if you just have $1,000 and you invest in one company that might do well, might do badly in the end, it seems a bit risky compared to being someone who can put money in a few different companies and see what happens.
Yeah,
Is that
definitely.
true?
Yeah, definitely. As a value investor, as we spoke about in the last episode, your success rate might be 30 to 40%. So yeah, you're right. You might have a terrible experience first up. Your first stock that you buy following this strategy might go down and it might demoralize you. So you do need to stick at it. But what we tend to find these days, because passive investing has been proven to be so solid over the long term, is that a lot of value investors are not just value investors. They are in part passive and in part active. And I'm like that as well. And Hamish, my podcast co-host, is also like that. And a lot of the people that I talk to, even when I went over to the Berkshire meeting in Omaha, a lot of investors there. I mean, that is the value investing mecca, but a lot of them still talk about tracking the market.
What's the kind of percentage breakdown you see of people? Is it like 80% passive, 20% value investing? What's the common thing that you see?
It really depends on how confident you are and like what your goals are. So for me, I love looking into these businesses. I find it really interesting, but at the same time, I know that the evidence is so strong for passive investing. And I know because I'm still young, I'm still early on in my investing career, and I'm not sure if after 40 years, I will still be in front of the market from I don't know if I'm going to be good or bad. So for me personally, I actually keep most of my money passively invested. And then, well, at least I did originally, and then a little bit of money towards value investing. My results are a bit skewed because I hit a 10x very early on.
Because you bought Tesla early on.
Yeah, in my career. So that's kind of that's really messed the balance of everything. But I think generally speaking, there's no harm in being mostly a passive investor. So you know you're tracking the market over the long term, you stand to benefit as all businesses kind of do over time. And then if you want to, if it's of interest to you, then you can start looking at individual companies that maybe you really believe in, or they align really well with your values, or you think there's a really good opportunity there. But like if it's not something, if you don't want to take the time and research companies, just don't do it.
Yeah, I don't do it.
Yeah.
I like to think that it's like maybe 90% of your portfolio. Like people have different opinions on this, but 90% should just be in those basic ETFs or index funds, managed funds that are tracking the market. And then with your extra 10%, you can either do this, pick companies, you can maybe buy some crypto, you can buy gold or other random things if that's what you want to do. Yeah. But it's a lot more risky if you're doing that with a higher percentage of your portfolio. Yeah,
the statistics will tell you that on balance, the average Joe investor will be better off if they are mostly a passive investor.
And like fund managers are mostly better off if they are passive investors too. And these are people with full-time jobs, which is just, wild.
But I don't want that to discourage people from value investing, because there is a reason why all the people that are very successful follow this 4-step approach. And if you are rational, you can make quite a handsome sum of money. You
just need to like manage the risk with it too and not put all of your money in it. Especially it depends on where you are as well. Like I was saying before, if you've got lots of surplus income and you can split it across like ETFs and some of this value investing too. But if you're someone with like $100 a week spare, maybe it's better off going into ETFs initially until you've kind of built that up and got that safety net there.
Yep, definitely. Yeah.
Lots of people fail. Why have you bothered to do it? Is it just the excitement of hoping that you will beat the market like you have with Tesla? What was the initial interest in it?
Yeah, I mean, I found looking into companies quite interesting. And once I really focused on being a rational investor and following that 4-step approach, I found it interesting that my investment returns started to really pick up. So my original stock picking strategy, because I've always been a passive investor, but I've also been picking stocks. But when I started picking stocks, it was like just throwing just darts at the dartboard, and it was just terrible.
How did you pick those original ones?
I did all the wrong things. I was just listening to what I heard online. I was following YouTube channels and being like, oh, this guy said it was all right. And I was buying those stocks and they'd inevitably go down. So that's why I go over this strategy so often with those 4 key steps, because you really have to be rational and follow those 4 steps to make sure that you're setting yourself up for success, I guess.
Tesla did really well. Do you think you were lucky with that, or do you think you could replicate it and do it again in the future with another company?
I think I could replicate it, yeah. But I also was quite lucky. I mean, there's always luck in everything, but there's also taking action when you see an opportunity. So there's elements of both in there. Yes, I was in the right place at the right time, but I had also done the digging. It was, to be fair, like a lot of value investors will say Tesla's not a value stock. Correct. Like it was more speculative. I was still following the process in doing so, but there was some holes. And that's the case. Like there's always going to be holes here and there. But I took the chance. I didn't put a huge amount of money in Tesla originally.
What's not a huge amount of money? How much did you put in?
Back then I started by putting just $5,000 into it.
Okay, so still a decent chunk of money. But
chunk of money, but I'm not here betting 200 grand on this stock that's,
run by this guy who can do whatever he wants.
Yeah, exactly. But yeah, even back then I was still quite passively focused as well. And I took a chance on Tesla and it did well.
And what do you do now? Are you currently researching stocks, or are you just putting money into passive investing? Or
well, at the moment, it's kind of my hand has been forced because the market is really expensive. And when the market is expensive, value investors typically don't find very many opportunities. And that's been the same. Like following that strategy, I haven't bought a stock this year, but most value investors will only make one investment or maybe 2 every other year. It's really infrequent that these opportunities happen. It's more what really tends to happen, say with what happened with COVID, the stock market all of a sudden it was just tanked. It just straight down. And a lot of companies, sure, we can say the whole economy was affected by COVID, but a lot of companies, they got through it fine.
They did really well. Zoom did really well. All these tech companies.
Well. But because the market just tanked and everyone was fearful, even the really good companies, their share prices went down as well for, what you could argue is no real good reason, no good long-term reason. So it's more about being patient, staying on top of your watch list, and then when these events happen, then taking advantage of them.
Mm-hmm. Do you think you can do that with like an ETF? Is it good to try and time the market? Like I've seen the research that says no, if you miss the best days and you've missed out on most of your returns. Can people try and like take this approach in that way with ETFs at all, or not worth it?
I don't think it's worth it personally. I think your mindset is different when you're buying ETFs because I would never buy an ETF to try and beat the market, to beat the average market return.
Because there's lots of like the thematic ETFs that are trying to do something a bit different.
Oh, sorry. Maybe I should have clarified. When I talk about ETFs, I'm just talking purely market tracking.
Okay. Well, there's like the ones like, IVV, S&P 500, the A200 ones. And there's so many thematic ones popping up now. Like there's ACDC and Robo and all these like AI ones popping up, or crypto ones too. So there's lots of those things trying to do something different.
Yeah. I to be honest, my style of investing, I wouldn't even bother looking at those because it's not value investing, because you're still looking at a diversified group.
Yeah.
So you're not looking at the individual company. You're not looking at the individual characteristics of each company. You're just looking at a group of companies, but it's also not market tracking. So I'm like, it's caught in the middle of something that I just don't care about at all.
Yeah. And I think it's a bit hard with their marketing. You think they're investing in things that they're actually not. So it's really important to look at what these companies, these ETFs actually hold. Like I know the crypto one confused people a lot because they invest in like blockchain businesses, not actual crypto. And some people bought it thinking they were getting like Bitcoin and Ethereum.
Oh, okay. Yeah. I don't know. That stuff to me sounds very speculative. So
yeah, definitely.
Yeah. But no, when I talk about ETFs, I'm talking about like tracking the S&P 500 as
like
boring as that.
IBV, A200, those ones.
Yeah. I'm not sure what the Australian ETFs are. I'm pretty much purely just S&P 500.
So we've kind of touched on it already, but why would someone pick active investing? It's someone who like they found a company, they found like an area they want to research, they've got the time, they've got the spare money. Is there any other reason someone would choose active for part of their portfolio?
Yeah, I mean, the reason that you choose active investing is either you have a real strong interest in analyzing businesses, you have a super hectic like moral compass, and you really want to make sure that the companies you have in your portfolio are only the ones that that align with you. And then the third one is if you want to try your hand at making a better return than the market. If you look at your long-term 40-year compounding chart and you put in 7 to 10% and you say, you know what, it's all right, but I want more than that.
Yeah.
So
it's pretty good though.
Yeah. But and this, as we said, the statistics will say most people won't beat the S&P 500, so it's pointless to try. But
and some people seem to think it's like a hobby as well. Like it's fun to keep up with these companies and get invested. And
yeah, definitely. Yeah, I mean, I find it really interesting to look into the companies in my portfolio and see what's going on with them. So I figure if I'm finding it super interesting and I think these companies are going to do well at better than a 7 to 10% return per year, I should invest in that. Yeah.
Interesting. Okay. So what are your best tips for someone who wants to get started?
With value investing?
Yeah.
I would say take your time. As I said before, it's not about trading. It's not about buying 10 stocks in a year. Most value investors, they find opportunities very infrequently. So take your time with it. Stick to your circle of competence. So ask yourself, where do I spend my time? Where do I spend my money? What am I passionate about? What do I do for work? Find those companies close to home. And even when you're looking at companies that are really close to home, if you're just not understanding or if you're just not interested, you might think, maybe you work in mining and then you're like, oh, mining stocks are up my alley. And then you pick up a mining company's annual report and you go, holy smokes, this is dry. Mm-hmm. Don't force yourself. Just put it in Warren Buffett's too hard pile and just move on to something else.
Yeah, be excited about the new Grand Theft Auto game and look into video games instead.
Yeah, like GTA 6. Like I'm a big video gamer and that's done by Rockstar, which is owned by Take-Two. And so, I'll be looking into Take-Two and I'm super interested in that kind of stuff. But yeah, and another, like I used to work as a physio, but when I looked into medical or healthcare companies, I was like, man, this is dry.
It's so complex as well with all the patent stuff and the rules around the FDA and other things like that. Like it gets really complex.
It gets really complex, which is fine if you like work at one of those companies or maybe that's your interest and you love looking into it. But for me, too hard pile. Mm-hmm. So I think take your time with it, stick to companies really close, and also just remember that to do it well, you have to be super, super rational, and you just cannot go speculating. If you're someone that does feel the fear when the market goes down 10 or you see 10% or you see your stock is down 10% today when you open up your brokerage account, if you just can't help but feel the need to take action because of something that the market is doing, value investing probably isn't for you, because you do need to be able to just wait out tough periods or, not get too excited when the market's roaring or anything like that. Like a lot of people right now are feeling that they're missing out, because the market's roaring. Nvidia, I've got to buy it because I'm missing out. Look at the returns, I'm missing out. I don't get Nvidia. I know that I've got a graphics card in my PC, but I don't know how graphics cards are made. I don't know how they work. I don't really understand. I understand computers at a basic level, but I'm certainly no expert. I don't know how to code. I don't know any of that. Yet so many people like, I must get into Nvidia. This is going to the moon. I'm missing out on money. But the value investor in my position would say, I'm comfortable letting it go.
There'll be other things.
There'll be other things. And what Warren Buffett would say in this situation is you only need 2, 3, 4 really good stocks in your entire investing career to come out well on top with this approach. Because it is about you can have a 30% strike rate and still do really, really well.
Yeah. It sounds like there's lots of positives and also lots of risks that come with it as well. But this has been very interesting for everyone listening. Thank you for joining us again. Where can people find you? I know you've got some courses as well. Where are they located?
Yeah, so just online, I make YouTube videos at New Money. We got the podcast with Hamish, the Young Investors podcast. And I last year started a business called New Money Education, which is trying to teach people the rational way to go through both the passive investing strategy and the active investing Warren Buffett style strategy. So they're just some video courses, very in-depth video courses, but kind of that leave no one behind approach. So you can find that at newmoney.education if you are interested. But yeah, that's pretty much me.
Amazing. Thanks for joining us.
Thanks for having me on.
Bye.
Thanks so much for joining us. If you found this episode helpful, please rate us 5 stars, write a review, or share with a friend. If you're new to investing, make sure to listen to our first 10 episodes. Follow us at Get Rich Slow Club or Tash at Tash Invest or me at Ana Cristina.
This show was brought to you by Natasha Etchman, who is an authorized representative 1299881 of Guideway Financial Services, AFSL 420367, and Perla, who is an authorized representative 1281540 of Sanlam Private Wealth, AFSL 337927. Knowledge is power, especially when it comes to investing, so make sure you check out our financial services guides and read the product disclosure statement and target market determination for any investments you're considering. See our show notes for more info.